Economic exposure arises when the present value of firms' expected cash flows change due to an unexpected change in the exchange rate. So as the exchange rates move, firms' future expected cash flows also do change because of two factors that we're going to refer in a little bit. One of them is that the company's competitive position is altered in the market, and two is that the company's cash flows are now translated at a different exchange rate into the local currency. So these dual effects do alter the company's future cash flows and eventually has an impact on the value. The economic exposure emphasizes the impact of exchange rates on operating cash flows. As a result, we call economic exposure also as operating exposure. From a long-term perspective, economic exposure is the most relevant exposure for a firm because it potentially alters the firm value. As I mentioned to you, these double impact due to the change in the competitive position of the company and the translation effect, the company's value might change dramatically as a result of changes in the exchange rates. The degree to which a firm is subject to economic exposure depends on the type and the structure of the firm and its industry. That is, the nature of the firm, the competitive position of the firm in the market, its configuration. All of those collectively determine to what extent the company is exposed to the exchange rate changes. In general, importing and exporting firms face a higher degree of economic exposure than purely domestic firms do. But that doesn't mean that domestic companies or the companies who do not engage in international business are not exposed to exchange rates. They are also exposed to exchange rates because their competitive positions might be altered as a result of exchange rate changes, because some companies in the same industry might be importers and exporters, and the changes in exchange rates might affect their position eventually, and has an impact on the companies that are purely domestically involved. So as I indicated, many purely domestic firms, that is firms that purchase all their supplies and sell all of their products domestically, also face economic exposure because their competitive positions are subject to change as a result of changes in the exchange rates. Industry structure plays an important role in here. Typically, monopolistic firms have a lot of room to adjust or respond to exchange rate changes. They are, because of their pricing power in the markets, they might pass the exchange rate implications on their clients, and as a result, they might be able to preserve their margins, but the companies in competitive markets may not have that luxury, and as a result, they might see substantial margin compression as a result of changes in exchange rate. So if the exchange rate changes increase firms' cost, a monopolistic firm can pass these changes without experiencing substantial decline in demand. Also, the companies who have products that do not have close substitutes might have this opportunity. So as a result, the impact of the exchange rate on those type of companies could be quite muted. But others who are in highly competitive markets might see their cash flows affected substantially. So a combination of factors, the nature of the firm, the industry that they're operating in, the type of products that they do have, the substitutes that might exist in the markets, would collectively determine the extent of the exposure that the companies have. Analytically, we could look at the economic exposure in the context of this model. As you can see in here, this is the generic valuation model. A company that has cash flows that are generated in the domestic market in domestic currency terms. And also the company has cash flows. In this case, we have a simplified situation where the company has, let's say, one foreign stream of cash flows in foreign currency. These foreign currency cash flows are eventually converted into the domestic exchange, domestic currency, and the total cash flows are accounted in domestic currency, and they are discounted at the a discount rate that is calculated in the domestic currency. Exchange rate fluctuations might also have an impact on the cost of capital, but the immediate impact is obviously on the denominator is here in the cash flows. Similarly, longer term implications are embedded in the terminal value of the firm. So any given change visibly in exchange rates would affect the domestic currency value of the foreign cash flows and eventually will have an impact on the valuation of the firm. So this is what we mean when we talk about the impact of the exchange rates on the firm valuation. So it does have a very visible and clear impact on the denominator, but also it might have indirect implications on the cost of capital of the firm, and certainly has an impact for longer-term cash flows. Eventually, collectively, they cause a change in the valuation of the firm. As I indicated earlier, there are two different implications of exchange rate changes on the firm's cash flows. One of them is a direct translation effect. That is when, even if the company's foreign and domestic cash flows do not change as a result of changes in the exchange rates, the translation effect simply translating these foreign currency cash flows into domestic currency at a different rate will have an impact on the cash flows. But at the same time, exchange rate changes affect the company's competitive position in the markets, both in the foreign and domestic markets. As a result, you might see changes that are occurring in the domestic and foreign cash flows. In addition to this translation effect, we might see also the competitiveness effect of the exchange rate changes. So they collectively determine the change in the value of the firm. So the alterations might be a combination of translation and competitiveness effect. Often competitiveness effect is much more serious on the cash flows. We are going to illustrate this by using a simple example. Ganado, Germany. This is the same company that we considered in transaction exposure example. So the company has a subsidiary in Germany. So it sells domestically and it exports its products. So we make certain simple assumptions just to make this manageable. In reality, this is a far more complex situation. But we will assume that the company has a constant sales volume expected from 2014 to 2018. The sale price per unit is set in euros at 12.80. We will assume on the base case these sales prices will be constant. Direct costs are incurred in euro terms. Again, for the sake of simplicity, we will assume that they are constant. The German corporate tax rate is about 29.5%. It's going to be constant throughout. And we will assume a constant exchange rate of 1.2 throughout this period as our base case. There are a whole range of opportunities that we can actually explore in here. But we will start with this very simple case. So here we have the valuation of the subsidiary based on these base case assumptions where the company is going to be selling 1 million units throughout from 2014 to 2018. The sales price is going to be 12.80, direct costs are 9.60, and this is the tax rate, German tax rate. And we do have exchange rate that is 1.2. I have a typo in here. This should be 1.2. So I will correct that. So at the exchange rate of 1.2, we calculate the company's sales revenues, direct costs, the cash operating expenses, depreciation, and we get operating profits of 1,710,000 euros in 2014. This is pretty much the same throughout. Income tax expense at 29.50 is in here. We have net income. Now we calculate the cash flows. The net income is 1.205, add back depreciation. We assume no working capital requirement change from 2014 to 2018. The free cash flow in this case 1,805,000. Converting this at the exchange rate of 1.2 into US dollars, we get 2,166,660. We will assume a perpetual growth rate of 3%. So based on this perpetual growth rate, we calculate the terminal value of the firm by using a constant growth assumption. So let me show you how I did calculate that. So we can calculate the terminal value as simply $2,166,660 growing at a rate of 1 plus 0.03. And this is discounted at the rate of the discount factors, cost of capital is 0.15 and 3% growth rate. This should produce 18,597,165. So this is our terminal value calculation that shows up in here. And then these are the annual cash flows, the subsidiary value altogether is equal to 60,549 as a result. Let me clean this up. So in our base case, our assumptions suggest a subsidiary value of 16.5 million. Let's take a look at these assumptions that we have in here. We said our sales volume 1 million, sales price 12.80 euros. So the importers pay about $15.36 price. So for the clients, export clients of the firm, the price is actually $15.36. The direct cost is 9.60 euros. Corporate tax rate we put in here. The exchange rate is 1.2. As I mentioned, this is a typo, so it should be 1.2 in here. The perpetual growth rate is 3%. Cost of capital is 15%. The average collection period is 45 days. Days in sales is about 10 days. And average payables period is about 38 days. We will need this information as the company's sales volume changes. There will be some changes in the working capital requirement, but at this point, We're assuming that there is no additional working capital requirement, and the company generates this value from its subsidiary. So we are going to consider several alternatives. The first alternative we're going to look at is a change in the exchange rate. In our base case, the exchange rate was $1.2 per euro. We will assume an appreciation of the US dollar from 1.2 to 1. And we will assume that the company does not change anything, and this exchange rate dollar appreciation does not have any impact on firms' sales volume or anything. So we will assume no response by the company, and no response in the market, or no change in the market. In the second case, we are going to assume that the company keeps its euro prices constant at 12.80 euros. Since the company keeps its euro prices at 12.80, when the dollar appreciates from 1.2 to 1, its dollar price declines in dollar terms. So it used to be $15.36 for the clients that are exporting Ganado's products. Now those prices are going to decline to 12.80 per unit. And we will see the implication of this particular case. In the third case, we will assume that the company will adjust its euro price to keep its dollar price constant. So the euro price is going to go up from 12.80 euro to 15.36 euro. And we will assume that when the company makes that change, the volume does not change. In the second option, in the second case, when the company's dollar price, or the export price, declines from 15.38 to 12.80, there's a volume increase of about 400,000. But when the euro price is kept, when the euro price is adjusted to 15.36 euro from 12.80 euro, we assume there is no volume change. This is disputable, obviously. We might consider that the company's price in the European market, or the price increase in the European market, might affect the volume negatively. And as a result, we might see some decline in volume. But let's assume that, that there is not enough competition in the domestic market to influence the demand. As a result, we will see the same volume of sales going in the market. And finally, in the fourth option, we're going to use a case where part of the dollar appreciation is passed on to the consumers, that the company actually makes an adjustment in the euro price from 12.8 to 14.08. So that has a positive impact on its export volume, but it could possibly have a negative impact on the European sales volume. We said that impact is muted, so as a result, the net impact in here would be a volume increase in the company's sales. And we're going to evaluate the implications of all of these four scenarios on the firm's value. So let's take a look at each of them one by one. So this is the case one, where the exchange rate changes, but nothing else changes. So in the face of an exchange rate change, but no other variable changing, the company's euro cash flows now are converted into US dollar at a 1-to-1 rate rather than 1-to-1.2 rate. So that means that the free cash flows as a result are going to decline, and the company's the subsidiary value is going to, as a result of this decline in the dollar cash flows, the company's subsidiaries value is going to decline from 16 million to almost 30 million. So about 3 million, 2.5 million decline in the valuation. So essentially, in this case, the discounted cash flow value of the firm declines from 16.5 million to 13.7 million, roughly about 16.66% decline. This is exactly in line with the change in the exchange rate. So we are assuming a exposure elasticity of 1, meaning that a 1% change in the exchange rate resulted in a 1% decline in the value of the firm. This is obviously a unlikely situation. So our assumptions here in the case 1, the exchange rate changes from 1.2 to 1, but everything else remain constant in this case. Since there are no volume changes, there is no change in the working capital requirement. Let's look at this particular case where the euro price is unadjusted, which then makes the export prices lower and pushes the volume by 400,000 units. So with the exchange rate change, as the imported goods prices decline, volume increases, and the company's sales actually go from 1 million units to 1.4 million units. The euro price is unadjusted, costs are not affected, and if we follow the path in here, the euro cash flows turn out to be 2,371,000. At the 1-to-1 exchange rate, that translates into 2,371,000. Now, there is an important issue in here. As the company's sales volume increases, the working capital requirement will have to increase, because now the total revenues increase to 17.9 million. As a result, we would expect to see the accounts receivables to increase, or investment accounts receivables to increase. Similarly, as the volume increases, the cost increases. That would mean an increase in inventory, and also change in accounts payable. So we calculate all of the changes that occur in accounts receivables, inventory, and accounts payables. So in the base case, the company had a working capital requirement of 841,644. To calculate the working capital requirement, simply we take the accounts receivables, add inventories, and subtract accounts payables. So this gives us the working capital requirement. In the case 2, accounts receivable, because of the increasing volume, increases. So does inventory, and also the accounts payables increases in here. So the way I calculate this, maybe I should show these very quickly. In order to calculate the accounts receivable as a result of change, what I do is I calculate the daily sales. So the sales revenues are 17,920,000. On a daily basis, assuming 365-day sales and 45 days of accounts the average collection period, so 45, I'm sorry, 45. So it is here. The average collection period is 45 days. So that should produce 2,209,315. So accounts payables now increased to 2,209,315. This is an increase as compared to the 1,578,000. So the change in the working capital requirement is 2,209,315 minus the previous level of accounts receivable, which is 1,578,000. 82, which is equal to 631,233. Similarly, I can calculate the the inventory changes. So the inventories are going to be the direct cost of 13,440,000 divided by 365. And then days in sales is about 10 days. So that gives me 368,219. So the inventories go up to 368,219 from 263,14. This means a 105,205 increase. Average collection period, similarly, by using daily purchases, that is 13,440,000 times 365 times 38 days of average collection period. So I will multiply this instead of 10 with 38, which will produce 1,399,233. So average collection period goes from 999 to actually accounts payables goes from 999,452 to 1,399,233. So that is 399,875 increase. So if I calculate the change in the working capital requirement, that is going to be 631, 233 in accounts receivables plus inventories, which is 105, 205 minus change in accounts payables, which is 336,000. And so 399,781. So that should amount to 336,658 in change in working capital requirement. So since this is a cash outflow, we will have to input here as a negative. So the net income plus depreciation minus working capital requirement gives me the free cash flows. So since this happens, this jump in the volume happens in 2014, so I only account for this change in 1 year. In the years ahead, neither volume nor the cost change. As a result, additional working capital investments are zero. So I calculate the free cash flows in euros first and then convert them into US dollars at the 1-to-1 rate. Finally, I calculate my terminal value again with the 3% growth assumption and 15% cost of capital, amounts to 23,243,000. So present value, all of these cash flows plus the terminal value, I get a valuation of 20,340,720. So under this scenario, the subsidiary value goes up from 16.5 million to 20.3 million. So an exchange rate appreciation, in this case, the dollar appreciation, had a positive impact on the dollar value of the subsidiary. And that is primarily because of this volume increase, which made by holding the euro prices constant, subsidiaries products became more competitive in the international markets. That pushed up the volume, and the volume increase led to a better valuation of the firm as a result. So this response of not changing the value of the price of the product, or initiative not to change the value of the product, helped the exports of the firm, and eventually it increased its value. So let's look at the third case where the euro price increases. That is, the company actually makes an adjustment and increase its euro price from 12.80 to 15.36. The cost does not change. As a result, the company's sales revenues with the adjustment in the price. By the way, this does not affect the volume. We assume that the company has market power in the European market, but it's so the price increase in the European market does not lead to a drop in the volume. Since its export prices also remain constant in dollar terms, there is no impact. So we have no volume implication of this strategy, but the revenues certainly increase. The revenue increase also leads to a working capital investment of 315,616. So that leads to a free cash flow in euros, 3,294,734 for 2014. Since in the ensuing years there are no additional working capital investments, the cash flows are slightly higher. This leads to a terminal value, again with the assumption of 3% growth and 15% cost of capital. The total valuation goes up to 27,234,933. So if you keep the euro prices, if you adjust the euro prices and keep practically dollar prices constant, we increased the valuation from 16.5 million to 27.2 million dollars. So this strategy has a much more dramatic positive impact on the value of the subsidiary. Again, in this particular case, we are assuming some market power in the European market. Otherwise, this will not have happened. The working capital requirement calculation is in here. What I did is just recalculated the accounts receivables, inventories, and average collection period. And the change amounted to $315,616. In our fourth case, we are assuming both a price adjustment and, as a result, a pickup in the volume in the export markets. Again, this implicitly assumes some sort of market power in the European market, where the price of the product goes from 12.80 to 14.08 euros, but the volume does not drop. But this triggers some increasing demand in the export market. As a result, we have 1.1 million sales volume. When we do the math with these, obviously the volume is increasing, Also, direct cost in this case is assumed to increase from $9.5 to $10. It was so I'm sorry, from 9.60 to $10. So both the sales price and the direct costs are increasing in this case. The implication, also considering the impact on the working capital requirement, net free cash flow turns out to be 2,489,590. When we project the future, the terminal value again at 3% and 15% cost of capital, we get 23,291,648. Which then translates into a subsidiary value of 20,481,000. This is more or less closer to the option two, but this also leads to an increase in the value of the subsidiary. So this is the type of analysis that we engage when we try to understand the impact of exchange rate changes on the firm value. As you can see in this example, we evaluated a range of options in a very simplistic sense, a range of options that might result in different valuations of the subsidiary, which eventually then consolidate into the total firm value. So this is what we are talking about when we indicate or refer to changes, the impact of the changes in the exchange rate on the firm value. So this is exactly what we are talking about. As we have seen in here, there are translation and competitive effects that are sort of combined, and they collectively have an impact on the firm value. So if we briefly summarize the conditions in here, in the baseline, our subsidiary had a $16.5 million value, with the exchange rate being at 1.2 and the 12.80 price point and 1 million units volume, and the direct cost of 9.60 per unit. When we just change the exchange rate, only account for the translation effect, obviously the appreciation of the dollars caused a decline in the subsidiary value from 16.5 million to 13.7 million. So the value of euro cash flows declined in dollar terms because of the translation effect. In other cases, we also brought in the competitiveness effect into the picture, and the consideration of the competitiveness effect, for instance, in the case of in the volume increase case, added up $3.8 million to the firm value. In another case, we assume that the company increased the euro prices, although the volume did not change, but this was also a competitiveness effect that eventually increased the firm value by about $10.7 million. And in the last case, where we combined both the volume and price effects together, we had about $3.9 million change in the valuation of the firm. You might consider this as a sort of a extreme situation, because this is a dramatic change in the domestic price, and not to see a volume decline in here is not very realistic. But if you take it at the face value, that added up the highest value to the firm value. So the subsidiary value was highest under those circumstances. So this is again The way we approach the valuation effects of the exchanges. Obviously, this requires meticulous financial modeling, and eventually we could measure the sensitivity of the firm value to changes in the exchanges. We could, as a management team, we could sit down and entertain a number of scenarios and see how a given shock into the exchange rate might affect our valuation. Obviously, the business configuration plays an important role in here. We could configure business in such a way that we could mitigate the exchange rate implications. If we properly diversify our costs and revenues, we might indeed minimize the fluctuations that we see in the valuation. And of course, that requires proactive management and strategic planning. Otherwise, we might be quite vulnerable to changes in the exchange. So this concludes the presentation. Just wanted to illustrate the impact of the exchange changes on the firm now.